Alright, what up guys? My name is Omar Opario, and today I'm going to be teaching you guys what's a fair value gap and what it's made of and what makes a good fair value gap versus a bad fair value gap. Alright, so let's start. So a fair value gap is going to be a three candle structure. So something like this. It's going to be three candles, it's usually going to have a body, it's going to look something like this, and it's going to be let's pretend this is the wick of a candle, and this another top of this is a wick, and this is another wick. It's going to be the body of the second candle that did not get mitigated. Alright, so that's super simple. And now let me just show you a visual representation. Alright, so fair value gap. This example, a fair value gap would be a three candle structure. Let's like imagine this. This is a one candle, this is a second candle, this is a third candle, and it would be just from the wick to the wick, and this would be considered your fair value gap. So super simple, and then eventually it gets mitigated, but like one day later. Alright, but yeah. Anyways, so now let's get into it. Let's understand that a fair value gap is just a three candle structure. It's a three candle structure, and what is it? And the gap is just a second candle that has not been mitigated. The parts of the second candle that has not been mitigated. What is it? How do fair value gaps work, and how do they form? So usually it just consists of aggressive market orders. So usually, as you can see right here, price consolidates for a while, and this is usually market makers stacking orders, holding orders in the DOM, at the top of the DOM, some at the top and at the bottom of the DOM, and they're just piling and piling orders before price makes an aggressive expansion towards one side. And what I mean by that is we can clearly see that here, where price usually just packs up, it stacks up orders right here, and then quickly place quickly in 5 minutes makes a mad aggressive move towards the upside. And what is it? And as you can hear, we have a London high unit, clears London high, clears a lot of sellers here, and rejects back down into the fair value gap. And this would be considered a good fair value gap, good probability fair value gap, because the price actually holds the fair value gap. And what is it? And usually what happens is, so there's going to be two things. It's called a market order and a limit order, right? So when you click market order, so it's going to look something like this, right? Let's say you click buy, right? Oh, well, market the order is rejected, right? But usually along the DOM or on the order book, there's a lot of resting orders, right? But when you click the order, but when you click physically the buy button, when you click the buy button, it just fills you in at whatever best price it could get you in, and then it starts moving. So price usually just stacks up orders and then aggressively expands towards to whatever side the market makers, what is it, or the algorithm wants to move the price towards you. Price here, as you can see, consolidated, move towards the upside, and let's go to replay mode and put this right here so I don't lose it. So fair value gaps consist of a price imbalance, and this price imbalance is usually made by aggressive market orders and insufficient liquidity in that range. So here's the range, right? So here's your three candles, right? So this is the range where there's insufficient liquidity, and where orders, not must, but most of the orders will eventually come back and get filled. Because if you guys remember, when I made my video on liquidity, not all orders get filled. So usually price or the algorithm naturally comes back and fills those orders if they're keyword, if there is orders resting right there. Because usually, what is it? Because usually you can cancel those orders and now, or you can reverse those orders, and now this fair value gap is not going to hold. But most of the times what makes a good fair value gap is when price actually holds and respects that fair value gap. So you can see right here on the 5 minute time frame, what is it right here? We accumulated a little bit, and then this is just usually accumulation. It's just basically when market makers stack up their orders before they make a price. What is it? Before they make a decision where they want to set market at and clear. Excuse me. We can see we clearly go towards the upside, and we take out this London high over here, and so it quickly took out this London high. Clearly, there's a lot of sell pressure here. Even took out this PM lunch. Clearly, there's a lot of sell pressure, so we click a dump 40 points. And now, if the fair value is going to be hold or it's going to be a good fair value gap, what is it? Price is going to respect that fair value gap, and this is a 5 minute fair value gap. So price comes. If we go down into the 1 minute, uh, we naturally assume that there is resting orders here that have not gotten filled. So, example, if you were going to trade a fair value gap, you would just set a long order here. But obviously, you have to have conviction. And depending on what your model is, you set an order, maybe try to target these highs and see how it goes for you. Obviously, it just depends on how the price goes. see price comes back, mitigates the sweeps a little bit more liquidity, and then comes back and expands more towards the upside. And then we can leave other fair value gaps on the upside. But yeah, that's just an example. Obviously, I wouldn't have traded this, but it's just an example of how a fair value gap would work. And usually, how you trade those fair value gaps is you usually leave them at the 50% range. For example, if you're gonna trade this, you can put the order at the 50% range, and your SL at the resting low right here, or something like this. You would hope to come back. Price fills your order that the market left, because price came swept quickly too, as it came and swept too fast. And yeah, and then what is it? And then that's how naturally a fair value gap would work. And then here, if you actually left it at the 50% of the range, you can come back, get filled in. Yeah, you can see quickly get filled in and quickly expand towards the upside very fast. But yeah, that's how a good fair value gap or a good probability fair value gap would work. Obviously, not all fair value gaps will get respected, because if so let's see, this is a fair value gap, right? Let's say people had resting orders right here, or market makers had resting orders. Let's say at the 50% of the fair value gap, or even right here at the fair value gap. Nothing stopping the market maker, or just to cancel the order. So if price was to naturally come back, it would just disrespect the fair value gap and just continue dumping towards the upside, and then you would have an order here, and you would quickly get swept out by the market. But yeah, that's just the basic of a fair value gap. And now let's go, what is it? Let's go deeper into the fair value gap and see what actually makes one. All right, so I want to talk about high time frame fair value gaps. And what a high time frame fair value gap will consist of, it's going to be a gap which usually would be located in the 15-minute, 30-minute, 45-minute, and then 1 hour, 4 hour gaps, 4 hour fair value gaps. These are going to be the main fair value gaps, the main high time frame fair value gaps. And the reason why these gaps are so important is because there's a lot of more resting orders there. There's more insufficiency in the market of those, what is it? Insufficient resting liquidity in the market. So price will naturally come back and be attracted to those to those gaps, to fill those orders that never got filled in. Now, it is important that I say not all orders get filled in. Remember, market makers can just cancel the orders, and price will never come and seek to rebalance the price at that area. And I'll show you a perfect example of a fair value gap that I guess you could say didn't hold well, or like a bad fair value gap right here, right? So see price here accumulates in the 15-minute, right? Accumulates a little bit here in the 50, oops, accumulates here in the 15-minute, right? And then we quickly have an expansion towards the upside. Alright, now this could be considered as the first percentage fair value gap, right? Which I'll get into later. But this is on the 15-minute, right? Then New York AM opens, and then price quickly comes and disrespects the fair value gap. So if you were to trade the fair value gap blindly, so you would put it to range at the 50% of the fair value gap, right? You would quickly, your position right here, you would quickly get stopped out and lose a lot of money, because you have to also have a thin conviction, right? There's resting low, there's London lows right here, Asia lows right here, there, and price naturally comes back to better time frames where liquidity is better resting, right? So not all fair value gaps will get respected, right? Especially when there's a fair value gap right there, and there's low resting, this is internal liquidity, this would be considered external liquidity. There's liquidity right there. Price would rather come and and take out this pool of liquidity than just a gap in the market. And that's the reasons why, I'm gonna say some of your fair value gaps just simply will not hold. Um, and yeah, so now let me show you an example of a fair value gap that does actually hold. Alright, so this would be an example of a high time fair value gap that actually does hold. And it is actually a higher probability fair value gap. So as you can see, this is on the 15-minute. Price quickly expands towards the upside, and we leave a fair value gap right here. Price comes, yeah, leaves a fair value gap right here, and then price comes, mitigates, drops down, and actually respects the fair value gap right here on the upside. Even though there was low resting liquidity right here, so you see this liquidity, most of it already got swept previously, so there's not that much resting liquidity right there, and price genuinely comes and respects the fair value gap. Now, when a fair value gap is respected, it is key important to say that that's where market makers think, okay, this is fair value, we're going to respect this, and we're usually going to hold towards the upside. Because how most fair value gaps work is, right, you have towards the upside right here, right? So you leave a fair value gap right here, right? Let's pretend this is the gap. Price comes, touches the fair value gap, and then keeps expanding towards the upside. And as you can see, we clearly do that here, right? So price expands quickly towards the upside. We have a fair value gap at the bottom, and then we come rebalance that price, come see if price is going to respect this area and then expand towards the upside. And a bad fair value gap would be something like, say this, right? So here's just 15-minute fair value gap, right? So price comes, touches again, mitigates price, comes again, mitigates price, comes again, and it's mitigating, mitigating, mitigating. Now, when price gets mitigated so much times like that, there's no more insufficient, like, there's no, how do I put it? There's no insufficient resting liquidity. All the orders that were here that got as it got filled already got filled, and now this fair value gap would be trash, and you literally would be trading trash price action. And if you would trade here and take a loss, I wouldn't even feel bad because how do I say it? Like you can clearly see that price is telling you, everything that needed to get filled in here already got filled in here multiple times. So this fair value gap will no longer be a thing, will no longer work. And so for here, like here, price comes, sweeps once, twice, three times, got all the resting orders that it needed to, and this fair value gap would probably be trash and never needs and probably would not work again. Even on higher time frames right here, like example here, we have first candle, second candle, third candle, so this would be the gap, right? Price loves to come and trade into fair value gap, into higher time frame fair value gaps. It naturally just loves coming to trade fair value gaps. So even if you were swing trading, let's say, obviously you wouldn't swing trade this, but if you're swing trading futures, you could take, let's say, longs, let's say from, I don't know, for some reason here, and just naturally target the fair value gap. And price will naturally do is naturally come and fill this order that I left right here, this gap right here, that price left. It's going to naturally come back and fill it, even to the brim, to the 50% of the range, or even the full inversion of the fair value gap. Price just naturally comes and loves to trade here. And you can see there was an imbalance of orders right here, because price actually makes a bearish candle, gets every single order that it must get, that it needs to get before it makes its move towards the upside. But then it quickly collapses. But that's the topic that's another topic. That's a topic for another time. But yeah, that's just with the high time frame fair value gaps, right? Now I want here we see another example where price naturally comes and trades into higher time frame fair value gaps right here. So right here we leave a 30-minute fair value gap and price comes, sweeps everything that needs to sweep, and actually it trades sideways for a good while. But eventually, even in the next session, we still have this high time frame fair value. Actually, here in the PM session, right in the New York PM session, for market close, price comes back and touches into the fair value gap, right? And this fair value gap actually holds because then price proceeds to dump pretty quickly, and that's how you know it's a good fair value gap. But then price is naturally going to come back and trade into that fair value gap, and then we're going to see if we're going to hold it or not. But yeah, price came back, traded into it, and then just the fair value gaps are also like, especially high time frame value gaps, is a place where price is naturally attracted to come and rebalance those orders that never got filled in. All right, now I want to talk about high time frame. I'm going to talk about high time frame fair value gaps and how price holds and loves to respect these fair value gaps. So price, here we have a fair value gap, here we have another fair value gap, here we have another fair value gap, and here we have another fair value gap. As you can see right here, right? Now price is naturally magneted to these areas right here. I'm going to use this fair value gap right here. Price, naturally comes and loves to rebalance all and mitigate all orders that never got filled in high time frame fair value gaps. You could use this to your advantage to trade into these fair value gaps or trade out of them, depending on whatever model you use, right? So example, right here, right? Price leaves a 1 hour fair value gap. Price comes, mitigates some of the fair value gap, and then proceeds to dump, like I don't know, like how much points is this? Like 100 points. So if you were trading a continuation model, you could just join off the fair value gap, target that pool of liquidity, and boom, 113 points on the day. Super easy trade. I mean, depending on your model, right? But this is just where price is just telling you, yo, I want to have resting orders here, and what is it? And if we're respecting here, then we're probably gonna come and seek to clear external range of liquidity. Or even better, like right here, right? We have another 1 hour fair value gap, right? So let's say, what is it? You wanted to come and trade it from fair value gap to fair value gap, right? So you would join shorts right here and just, I don't know, target the 50% range of the fair value gap. You would just clear out a little extra more points. And you can see price actually respects this hour fair value gap, mitigates, and then proceeds to dump again. But even if you were trading into fair value gaps, and we put it like this, right? So here we have, you know, a 1 hour fair value, still the same 1 hour fair value gap. And you were to join longs of, I don't know, like join longs here for some reason, right? You can naturally target this 1 hour fair value gap that's only got mitigated once, and then easily hit take profit, right? But eventually, you know, this fair value gap is not gonna hold for the rest of eternity unless, you know, somebody really wants to hold the United States economy down based off here. But what is it? This fair value is not gonna hold for the rest of eternity, so the price is eventually gonna mitigate all the orders that left right here, and then proceed to make higher highs or lower lows, whatever price needs to go do. And you know, this works really good well on the higher time frames. Here I'm gonna put a 4 hour example, right? So let's go find a 4 hour fair value gap, if we even have one. All right, and this works especially good on higher time frames, right? And it can give you a good conviction of price right here, right? So here we have a 4 hour gap, super simple gap that we left right there in the market, and you know, price eventually comes back and trades down into it, right? So if you were to hop in a lower time frame, let's go, hold on, put this right there. Yes, right here, you were to join shorts. Let's say you found some reason to join shorts right there. You join shorts, raw stuff right here. You can target the 4 hour gap that never got filled in. You know, this would be the 4 hour gap. Fills in, and then you just join shorts, and then you see how price plays out, and then eventually price will naturally come and to reseek back, you know, to price will come back here to, how to say, rebalance the orders that never got filled in, right? So there was resting orders here that never got filled in, so price is naturally going to come here and, you know, fill those orders, and your TP would be hit well, not instantly, but you know, eventually it would get hit if you're treating a continuation model, and see where prices wants to go. Let's wait for that order to get hit. Oh, anytime now. Anytime now. La la la. There you go. So eventually, price came down, touched that order, and then yeah, that was pretty simple. Simple example. You know, you can go back test this yourself, right? I'm not gonna sit here and back test it all day, but it's just a thing that price naturally loves to come, and you know, just price naturally comes and rebalances the orders that needs to be rebalanced. Um, yeah, but let me see if I can find another example, right? All right, so here we have another example of high time frame fair value gap, how price naturally wants to come and trade into this fair value gap, right? So example, let's say for some reason you see this 4 hour gap, right? But it's probably not gonna get mitigated that same day. Here's the thing a lot of people can understand, like just because you have a high time fair value gap right here, it's not gonna get mitigated the exact same day. So here Tuesday we left that gap, Wednesday we trade and we haven't even traded nowhere near it, and then Thursday, you know, the gap is still here. But if let's say Thursday you think, oh, maybe price came swept liquidity, you know, you're gonna join longs for some reason. Eventually, price is gonna come due. It's coming and actually fill the. Oh, what the heck? You know, naturally, price is gonna come back and fill that gap. It doesn't have to be the exact moment, but you're going to see the price naturally comes and was filling in the gaps that it left. This is a 4 hour gap left right here. So there's a lot of orders that have not gotten filled in around this area. A lot of people have take profits, stop losses right there, whatever they might have. There's a lot of orders that need to get filled in. So usually for me, how that I see is, you know, a lot of people try to join shorts, especially market makers. You know, they couldn't get their positions filled in, so price naturally leaves a gap because price was moving way too fast for the orders to get filled in, and then eventually, you'll see that price comes back, fills that gap. Obviously, I'm gonna have to speed this up, or else we're never gonna get this. Oops. Let's see, speed this up. How do I speed this up? Alright, there you go. So eventually, oops, there you go, too fast. Yeah, but you see, as you can see, price came back, filled the gap in. Very, very simple. This is like just another way how you can see how how price wants to move. And yeah, super simple. And as you can see, here's the here was the gap range that price still trading inside of it, rebalancing all the orders that needs to get rebalanced. Now, I want to talk to you guys about a thing called the first percentage fair value gap, right? Alright, so in trading, there's a thing called first percentage fair value gap. And what I mean by that is that the main fair value gap, the market leaves after an aggression move towards one side, is going to be the only and main important fair value gap. The other fair value gaps are just going to be noise. And this is exactly what I mean right here. So this is the first 5-minute percentage fair value gap, right? Price accumulates orders for like let's say right here. Actually, a lot of the London session accumulated orders, and then price dumps towards the upside, like let's say 116 points. Wow, price dumps 116 points towards the downside, right? And you can see there's a lot of sell pressure right here because that's a that's a pretty hefty move. So price then accumulates, and throughout the PM session, price comes, touches the fair value gap, and it actually holds the fair value gap, meaning that this fair value gap was actually the only main fair value gap right here. Because we can go into the time frames, right, and let's see like, oh, here's a 5-minute gap. Well, this is just going to be noise because just the gap, just the price, super small gap. The price left, price comes, and, just mitigates it super fast. This is literal garbage, but it actually respects the only important gap that we left in the market, and it's the first percentage fair value gap. And you can go back test this. You can go into any time frame. You can see that the first fair value gap is the only fair value gap that truly matters. Even when you go into the 15-minute, use this. This is the only gap the price is actually holding and respecting. If we go into higher time frames like 30-minute, here we can see that this is the first gap that the market left. Price comes, respects it, proceeds to dump immediately. And currently, not currently, but select bar, go into present time, and then price comes and touches again, mitigates it, and yeah, this is where price is naturally attracted to. And the first fair value gap is going to be the only gap that matters. Other gaps, especially on lower time frames, is going to be straight noise. So example, here we have on the 1 minute right here, right? Price before market opens, price quickly and rapidly expands down towards the downside, leaving the first percentage fair value gap right here, right? This is the 1 minute, the first 1 minute, the 1 minute fair value gap. It's the first percentage, right? So price quickly dumps, comes and mitigates this fair value gap, and because it's the first percentage one, there's going to be the most sell pressure right here. So when price actually comes and respects that fair value gap, and then we proceed to quickly dump towards the downside, and then we see that again. That price comes again, probably all the orders already got filled in, and the price mitigates its fair value gap and it no longer holds. I want to talk to you guys about low time frame fair value gaps, right? And now low time frame fair value gaps consist from the 1 minute, even down to like the 15 second, anything from like the 15 second, all the way to the 5 minute. That would be considered a low time frame fair value gap right here. Now the thing with these gaps is a lot of these gaps could just be noise, like it could just naturally be noise, and price doesn't come and respect these gaps. So example, this is the 1 minute. This is Nasdaq 100, the 1 minute. So here we have a gap right here. This is a 1 minute gap. Disrespected, doesn't hold, complete garbage. Here we have another 1 minute fair value gap. Price comes, destroys that gap, garbage. Here's another 1 minute fair value gap. And this one actually price kind of does respect. So this is a genuine gap. There was genuine orders, right? There was genuinely orders right here for this expansion towards the upside. Price does come down, mitigate as much orders that needs to get up, and actually respects it before going towards the upside. But things with low time frame fair value gaps is that price is usually not going to respect most of these, right? Because a lot of this is just noise right here. So you can see right here, or this right here, accumulation, and we leave a gap right here. Then quickly gets touched again, just mitigated, getting every single order that needs to get. I mean, naturally, like you can see that there is insufficient, insufficient liquidity right here, and market think this is a true value. So I mean, I guess you can consider this like true fair value. and then price comes and expands again. But yeah, a lot of this is just a lot of these fair value gaps is just noise, right? And just going to be internal liquidity, where internal liquidity is just resting. As you can see here we have the 5 minute. Here we leave a gap, right? Before we quickly expands to the upside. Price comes back, mitigates this, and all the orders that needs to get filled in. And I mean, I wouldn't trade this. This is just literal sideways. So that's just it's just bad trading. Even here we have like the Asia session right here, right? We have a gap right here in the 5 minute, like example right here, a 5 minute gap. Price does not hold this at all. Price comes back, flips through, and yeah, disrespects that gap, and then yeah, it just doesn't trade. It just doesn't hold a gap. And yeah, this is just because, you know, market makers can just cancel all the orders that they have in there. All right, now last thing I do want to talk about, and it's pretty important, is that not all fair value gaps will get filled in, and that just price naturally doing its own thing. So don't expect every single fair value gap to come get filled in right here. So here we have a perfect example, right, where price comes, leaves a fair value gap, and we never see the rebalance of this fair value gap ever again. So you could have a resting order right here. You would have never ever got filled in. Price comes, tries to, is close to, and never ever fills this fair value gap again. And here we just left the fair value gap, and you will never see this fair value gap filled in, probably for the rest of eternity, unless Trump tweets something, obviously. But yeah, I just think the price naturally does, right? And don't expect every single fair value gap to get filled in. Even if we go to lower time frames right here, I'm gonna go to lower time frames right here and show you an example of a low time frame fair value gaps not getting filled in. Okay, even right here, smaller than the shorter time frames right here. Here we leave a 5 minute fair value gap, right? And we're going to see if price comes in refills this fair value gap. So let's say if you were to ever leave, it's gonna be a good fair value gap, right? Accumulates, price quickly shoots up. So this looks like a good fair value gap. Let's see if the price comes and fills in this gap, right? Maybe. Let's speed this up a little faster. Yeah, this fair value gap is never getting filled in, and price just continues exploring towards the upside, exploring. And I don't think we'll ever gonna see this fair value gap ever get held or does ever come back and get filled in. But we do see some fair value gaps, look even right here. Price missed it just by a little bit, and we never saw the true rebalance of this price range. Some fair value gaps will get filled in. Such as example, there was another I think I'm going to the 5 minute right here. There was another fair value gap. Like, oh, okay, never mind, perfect. Actually, this is even better right here, right? So this is like a 5 minute fair value gap we left right there. Price came, respected it, swigged out little bit, and shot up towards the upside right here. But some fair value gaps do get filled in, but not right away. As you can see, here we have, a lot of time later, price came, you know, rebalanced the price and swept liquidity. This put liquidity. I'm not sure why they didn't sweep this one, but price came, swept what it needed to swept, and came back and filled in the gap, and eventually expanded towards the upside, 200 points, and never filled in this gap. But yeah, that was it for fair value gaps. So, it's pretty simple. And yeah, it just conforms. At the end of the day, fair value gaps is just resting liquidity. It's when price moves too quickly. Not all orders can get filled in, and just resting liquidity. The price needs to come and rebalance. My name is Omar. Hi guys, my name is Opario or Omar. And if you learned something, make sure to drop a like, subscribe to me. And I really